Well, hey everyone, I'm very glad to have Jamie from Mina to be with us today. He is a crypto tax professional in the country of the United Kingdom. So we're going to be talking a little international tax today. And this is an exciting day. One of the interesting things about the UK, Jamie, is that you don't do your tax year starting January 1st, like in the US. You, for some reason, it's like what, April 5th that the tax year ends or starts. Could you talk a little bit about that?
Yeah, it's so thank you for inviting me here and having a chat. It's always a pleasure, and it's always good to get the US versus UK tax perspective of things, especially around crypto. But the actual tax year itself, I think it's rather an archaic thing at the moment, and I think it's going to take a lot for things to shift somewhat dramatically. But yeah, so our tax year runs from the 6th of April to the 5th of April, and then you have until the following January to submit and pay your tax returns and your tax liability subsequently. Unless you have to file it on paper, then you have until the end of October, not the following January. So yeah, you've got a little bit of time, and it's a bit different to the US, I guess. We do have something coming in supposedly soon. This has been going on for about a decade now. Something called Making Tax Digital. I don't know if you've heard anything about
No,
that.
no.
No, so it's all about trying to mitigate errors and issues and just making it a much more smooth transition into the, I suppose, 21st century, if you like. And this will likely entail a quarterly reporting throughout the year. So this is when we start to get the sort of January, sort of more annual based, if you like, because it's quarterly starting from roughly April.
So, like, you already have the PAYE system, which is basically a withholding program as people have their paychecks, right? So, is this making things digital? Is this talking about other types of like that the PAYE system doesn't apply to capital gains, things like that?
Yeah, absolutely. So I suppose the first thing we need to acknowledge is that, unlike I believe in the US, not everyone needs to do a tax return. In fact, most people don't do a tax return in the UK because we have this PAYE system, which is pay as you earn. So it's all deducted at source, it's all calculated, it's all done for you. The only time you need to do a tax return, there's several reasons, but the main ones are you're self-employed, perhaps. Maybe you earn over a certain threshold. Maybe you've got some capital gains tax or untaxed at source earnings, basically. So there are several reasons, but most people in the UK do not do tax returns. So yeah, PAY is the reason.
In the US, twice the IRS commissioner has made proposals to Congress to move towards a approach where the IRS actually issues a pro forma tax return to people, and they just sign it if they're acceptable with it. And just this, the U.S. persona is like, no, 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 we can't let them think about that. Like, we can't let them do our taxes and be evil. So it's always gotten shot down. But in recent, just last year, they started a program where they actually have a free filing system,
Okay.
particularly good for people who are, I'd say, making under 75,000 and have a otherwise simple uh, tax life. And the idea is like, because this is that area where there's a lot of fraud in the US. And so they're thinking if they just automate that part, they can eliminate a lot of fraud. But, it'll be a cold day in hell, I think, before Americans ever accept the IRS issuing a pro forma.
I think you're right there. And the interesting part of all this, I think the blockchain technology would really help with this type of progress with the tax system in the US and this automated, not automated system, but the ability to have something transparent and an open ledger for all to see with certain blockades to sort of privatize personal information. But the speed and the availability of data and access of data, I think with blockchain technology would be incredible for the US if that's what they're going towards.
There's a possibility of that. I think the US is actually going to do something even far radical than that. But tell me about capital gains. You said there's a change in the capital gains taxation in the UK. How's that going down?
Yeah, so we had a budget in October. I think it was the 30th, roughly. And from that date, they made a few changes. What's important to those in the crypto space, at least, is the capital gains rate change. Now, we all knew something was coming. A lot of people saying it was going to be this or that, myself included. I thought it was going to be a lot higher. Um, But prior to this, it was 10% for basic rate earners, anyone within sort of about £50,000. Anything above that total income, you're looking at 20% tax maximum for capital gains, which isn't too bad, I don't think. Now, as of the 30th of October 2024 onwards, that rate has now changed to 18% and 24%. So what that means is for the first time in quite some time, we're going to have a situation on your tax return for the 24-25 tax year, because it's April to April, where part of your gains in the year will be subject to one tax threshold, 10%, 20%, and then the other part will be subject to 18% and 24%. So we need to split. When you made the gain is important in this year, basically. So you should have two separate sections. So accountants may be a little bit delayed this year than usual because they need to wait for this crypto software to update to accommodate for this, or they need to deal with it manually, which is fine on the most part, depending on what software you're using. And then we need to wait for the tax software to catch up. And then we also need the HMRC systems to catch up as well, which I'm hoping should only take a month or so from now, but who knows?
Oh, politicians think of great things to do, and then they leave it to the bureaucrats to work it out. It's just a nightmare, huh? They couldn't let it start at the next tax season. No, they had to impose it right away.
So this is the thing. A lot of people also thought it would come in after a while, but I believe there was a worry that people would just leave the country, or maybe even dispose of more assets prior to the change, therefore crashing the economy. But I don't know. I think it's all very melodramatic, and it's all but what are the tax rates in the US for capital gains, by the way? I completely forgot.
Capital gains taxes in the U.S. are divided between short-term and long-term. So short-term capital gain income is taxed as ordinary income. And I think maybe, for our listeners, in contrast, like in Canada and also in many countries, they will take the capital gains, they'll divide it in half and then tax it at ordinary income. What you were just describing, the old tax regime, was basically 50% of the ordinary tax brackets. So, that's kind of the 50% thing is easy for people to understand. Although in Canada, they do it 50%. You guys do it by having half the tax rate. But in the US, we tax short-term income at ordinary tax rates. So bottom line is we really tax short-term at a much higher rate than you guys will. That being said, also our tax brackets for short-term run, we got like 7 plus tax brackets, but it runs from basically most people are in at the 22-24% rate, some up at 32%. So that's a lot. Long-term capital gains rates, if you hold an asset over a year before you sell it, is 15% until you've made like $500,000, and then it's 20%.
So say we have a UK listener who is talking to their friends who is an American citizen and say, hey, you should check out Jamie. He knows what he's talking about. They go, oh, hold on, he's for the UK personnel. This person doesn't want anything to do with the UK, lives in the US, pays US taxes, and has crypto, and just knows a guy in the UK. And they go, what do I need to do as an American with crypto? What's the top 3 things I should know as an American who has crypto? What should I be doing?
Well, one thing to know in this context of a UK and a US person talking about their crypto taxes is the US taxes its US citizens on their worldwide income, regardless of where they live in the world. Okay. So if you're talking to your UK friend, but let's say he's living down in Dubai, all right, he's not paying any taxes because he's out of the UK, all right. But as a U.S. citizen, regardless of where you live, you have to pay taxes on your income. It's worldwide income. That means even if you made it trading on a foreign crypto exchange or anywhere else, it's still income in the U.S. You got to pay taxes on it. Okay. So big, major difference. Every other country in the world is like, if you live here, you pay taxes. Don't live here, after a certain period of time, you don't pay taxes.
Okay, so it doesn't matter where you are in the world. If you're a US citizen, you're paying US taxes at some point, even if you have crypto, dispose of them, unless I suppose some caveat is met.
This is exactly true. Second thing would be for a US person is anytime you sell, exchange, swap, trade one crypto for another crypto, that you experience some sort of gain in US dollar terms. All right. Now, of course, you might be saying, I didn't go to cash. I just went from Ethereum to Solana, but you experience some gain on the sale of that asset. You bought the Ethereum at this price, you disposed of it at a higher price, there was a gain. And that is the gain you pay taxes on. Your net of your gains and losses for the whole year is what you pay taxes on. That price that you sold it at, the fair market value in US dollars of that Ethereum, when I swapped it for Solana, that establishes the cost basis of the Solana as well. So a lot of Americans think that they're only subject to tax when they go to cash, when they actually swap out to US dollars, not even, but whether you go to a stable coin, another crypto, or dollars, you experience a gain. You simply do. And that's how they would measure it in US dollar terms.
And that's interesting because that's exactly the same in the UK. And it's the same issue that we have as well. A lot of people come to me say, Jamie, I've made X amount. However, I've not cashed out. I go, excellent. Was it in a meme coin? Yes, it was. Okay. Is it still in the meme coin? Of course not. Why would it be? I have to go in. Well, you've crystallized a gain or a loss at the point in which you exchanged from your meme token to whatever it is next. And I think that's what catches people out. Some people will go from, say, Trump coin, for example, to USDC, and then trying to leave the UK and then cash out to not pay taxes. Unfortunately, that doesn't work that way. And so it's good to know. What would be your third thing as a US citizen to know?
The third thing, and this is brand new this year, IRS put in new regulations called the broker-dealer regulations. There's two aspects to this. What this means is two things. One is a little background. In the US, at the end of the year, because we have a calendar system, whoever pays you money, any company that pays you money has to issue a 1099 form to the IRS. You get a copy of it. And this 1099 form says how much you were paid. And we do this for stocks and bonds. It's called a 1099B for broker. And it lists, you bought this Google stock at this price on this date. You sold it at this price at this date. Here was your gain. And it's actually a wonderful document for tax preparation because all you have to do is put the totals in on your tax return and you're done for your stock reporting. But for crypto people, we don't, you typically aren't buying, holding, and then selling on the same exchange. So what's going to happen starting in January of 2026, these exchanges, Coinbase, Kraken, Uphold, Robinhood, they're going to be issuing 1099 DAs for digital asset to the IRS, and it's going to report the value of all your sales. But they don't know what the cost is, especially if you'd moved an asset over to a hard wallet and then you brought it back. Coinbase wouldn't know what that cost basis is. So you're going to have big numbers reported, especially the more frequently you trade. If you're like a higher frequency trader, in and out, in and out, in and out, you're going to have a lot more sales, right? Not a lot of profit, but a lot more sales. And that's going to really significantly inflate this number that's being reported to the IRS. It's going to get the IRS excited because it's not going to know how much the cost basis is. They're just going to see something big. Back in 2018, I had a client. Well, Coinbase was issuing 1099s back then, and this one client had a $4 million 1099 be issued on his Coinbase earnings for that year. And the IRS got excited, initiated an audit. He hadn't really reported it on his tax return, which is a bigger issue. But when we finally did the gain calculation, he had actually lost $17,000. But the IRS can't see that. All they can see is you got this big $4 million gain. What this is going to do is it's going to create a real problem because now, think about this. I'm going to use one of these online gain calculation services. Like, let's say I use Coinly, all right? And I plug in my numbers and I come up with my total proceeds, total gains, all itemized out. But then I can't report that number because because Coinbase has already given this 1099 to the IRS saying I made $100,000, or let's say it's a bigger number, $1 million. But my own gain calculations say I only made 50,000 in profit. All right. So now I have to subtract out somehow the 1099 because there's going to be a duplication of reporting.
I see. Yeah.
And then the question is, do you do this? Will services like Coinly provide a vehicle for you to input what you have to subtract out? You wouldn't do it there because when we file a tax return, we type in the fact that we got a 1099. We type all that data in. It doesn't really show up on the tax return unless the total hits somewhere in the return. But the fact that you entered the 1099 doesn't show up, but it's electronically stored in the tax return. So when it's submitted to the IRS, the IRS can see, oh yeah, you accounted for that 1099. So one of the biggest ways that people get audited is if they fail to enter in all the 1099 information into their tax return, because the IRS will see that and then they'll say, oh, this guy didn't report income, and they'll issue you a bill for the unreported income. It'd be staggering. Tax reporting next year is just going to be through the roof. And there's only one saving grace, though. Second problem with this broker dealer regulation, I'm sorry, is now when we do gain calculation on Coinly, you must use FIFO, first in, first out method, and you have to do it by wallet. You cannot do it universal, which is typically how everybody does it. Now, of the eight major systems that do online systems to do gain calculation, only 4 of them support by wallet management. By wallet means if I sold an Ethereum, I have to, when I go to find out the cost basis, it has to be the cost basis of an Ethereum that's in the same wallet. So that's complicated for 2 reasons. One problem is if I've been doing it a different way up until 2025, now I got to do it another way. Well, how do I reconcile that difference? They did come out with a transition plan, but we worked really hard to let people know about it. We got about 10,000 people who signed up and helped them that transition plan. But if you didn't sign up for one ahead of time, you're hosed. They're going to use the FIFO by wallet method automatically, and they're going to use it retroactively on all prior years. So it automatically, virtually everybody in the U.S., their gain calculation on prior years is now invalid. So particularly invalid. Now here's the problem. Think about this. When you know how when you load in wallet address data, right? Lots of especially you have multiple exchanges, and maybe some of those exchanges are closed. There's missing records, right? There's missing buys, there's missing sales, and this kind of thing. But when we do a gain calculation and we use a HIFO method, or typically it's like a LIFO, it's very close to LIFO. You're basically selling the more recent coins. So it allows us to generate less, to show less profit, and which leads to less tax. But the IRS is going to go back to the FIFO. Now the problem is if you have, over time, everybody should understand this, all systems like Coinly and Coin Tracker and these things, they all become detached from reality. They do it the first year and it becomes worse every single year. They have no idea where the coins are. There's missing coins. So if you had a coin you bought back in 2014 and you lost the exchange records, but somehow it's still in Coinly, it's not going to bother you until you go FIFO. And now all of a sudden you're going to sell a Bitcoin and it's going to go pull the price for 2014 on this coin that in reality you don't have, but the records say you do. And so all of a sudden you're going to have these massive capital gains, which people are going to say, like, there's no way that ever happened, because of bad records. So we're in next year, gain calculation is going to be a nightmare.
It does sound like it's going to be horrendous, but it sounds like you guys are ready for it and are gearing up for this war with your clients, with all this going on. It's interesting to pick out some certain things with what you've just said. For example, you talked about the LIFO and FIFO method, which for the listeners is last in, last out, first in, first out, which is an accounting mechanism, if you like, with the US. In the UK, we have something called weighted average cost. So it's just the average over the entirety of that asset class. We do have bed and breakfasting rules. So the average is initially on a 1-day basis, and then within 30 days, and then everything else, which to me sounds very straightforward, but probably sounds like absolute alien to someone who deals with the LIFO and FIFO method. So that's quite interesting to see the comparative there. And I didn't realize that, I think you mentioned Coinbase, other centralized exchanges might be doing the same, I presume. where they report to the IRS on behalf of people who are with them who have clearly KYC'd in order to use said platform, and then
Yep.
they might be overstating their taxes by not including the amount that's already in there, or by not submitting their taxes and therefore including a base cost. So therefore the entire thing is taxable rather than perhaps a smaller bit of tax or even a loss, as you mentioned with one of your clients. There's similar things happening in the UK with from two fronts. The first one is where I believe Coinbase are reporting anyone who has any more than I think it was 5,000 at the time, to HMRC to give them a nudge to say, look, you've got significant assets on Coinbase. You might want to do a tax return. We don't know the full details. You might want to consider it. And the other thing is the proceeds issue, which you mentioned. You mentioned how it's quite easy to have high proceeds with high volume of transactions. In the UK, if you do a tax return, if you have to do one for other reasons, and your capital gains proceeds are over £50,000, you need to include that on your tax return, even if it's a loss, even if it's a small gain, it comes under the reliefs. Now, that 50,000 threshold for normal non-crypto assets is relatively okay. But as you mentioned, with crypto, if you only have, say, £5,000 worth of assets and you were to swap it from Bitcoin to Ethereum and then back again, you do that 10 times. 10, well, call it 20 transactions, including the buyback. 20 transactions is very low for a year for the average trader in the crypto space. Don't you agree? And
Yeah.
average value for those transactions is okay. It's about, standard. This will breach that £50,000 threshold because the proceeds are £50,000. The cost is £50,000. The gain is zero, but you've already gone part. You've hit that £50,000 threshold. So what I tend to see is a lot of people have millions and millions in the proceeds, but similarly with the costs, and then their gain is far more appropriate, shall we say, and accurate, because the two kind of shock both HMRC and the client when they go, whoa, I've never seen 10 million. HMRC go, well, hold on, 10 million proceeds. It's like, well, the client's traded a lot at an average of £10,000 per asset, so that number quickly stacks up. But if you look at the cost, it does as well. I suppose you must be finding something similar with your clients, because it sounds like an international thing.
It is a big thing. I mean, it's yeah, you're right. It's an international problem. In the U.S., a couple of years ago, the IRS commissioner committed to Congress that he would stop, or actually, I shouldn't say stop. He would increase the audit rates on people making over $400,000, and that they would not increase the audit rates on people making under $400,000. And that was like, we're going to audit the rich, right? But who's rich? All right. So when when the IRS looks at 400,000, they're not talking adjusted gross income.
Oh,
They're talking total positive income. Positive income is income without the expenses. So it would be your proceeds without considering the costs. It would be if you have a sole proprietorship that's reported on your personal income tax, it would be the revenue, but not the expense. So all of a sudden, it doesn't take much as a crypto trader to pop up into the rich category, okay? Because we're looking only at total positive income. And this is President Biden was saying this, Secretary Yellen, oh yeah, we're only going to go after the rich people. Well, when you measure it that way, it's not hard for everybody to be rich. So what this does mean is that crypto traders are in the target zone of where the IRS is focusing its energy. I mean, and here in the U.S., they're having layoffs in the government. They laid off all the probationary workers in the IRS and the rest of the government these are employees that had only started in the last year or so. They would be like trainee or probationary employees. So that got rid of 7,000 people. They also had a voluntary early retirement program, which is a lot of older people in the IRS. I'd say average age of the IRS is at least 60 years old. I mean, it's really up there. And because they haven't hired for a long time, and so they got a lot of older people. So plus there's the Doge program is they're looking aggressively at the IRS. They haven't announced anything yet, but I understand that they're bracing for potentially 50% reduction. If that happens, I believe they'll get rid of a lot of the middle management, a lot of the research arms, because fundamentally, a tax business is about collecting money. So you got to have auditors and you got to have revenue officers who go out. Revenue officers, a tax collector, and those guys I think they'll keep because without them they're not going to bring in the money. They'll get rid of phone support, they'll get rid of everything else, but they'll keep those. Probably what they'll do is they'll subcontract all the work out.
Well, I was about to say someone's got to do the work, so
Somebody's got to do the work.
More long term.
So yeah, I mean that's happening. It's a pleasure talking to you, Jamie. I wish you the very best.
Thank you, and you. Always a pleasure. I'm sure we'll do another one soon.
All right, good. Thank you very much. Hey, so that was fun. We got a lot of snippet material there.